Let's open with this. Anytime that I see the phrase "Okay, boomer" or "Hey, boomer," it's usually followed by something snarky written by someone from a younger generation. However, this headline actually got me. It said, "Hey, boomer, you're addicted to stocks." The article said that the boomer generation, despite the crash in 2008, it's had a lot of success with stocks in the market. And as they enter into retirement, they're having a hard time divesting themselves of that risk, letting go of the risk that they've got, letting go of the market allocations. They're addicted to that growth. Do you find that to be the case, Nolan? And if it is, how do you help wean them off of that?
I have seen a lot more of equity ownership in people that are close to or in retirement time. And, I guess looking back, it makes a lot of sense if we think about the last extended downturn that we had in the market was 2008. We did have a couple of years in there that were negative, but they quickly rebounded. And so, equities for the most part, were a pretty good spot to be since 2008. And I think a lot of the people that are closer to or in retirement time now, maybe have forget about what some of the pain of 2008 can cause. And, if they were younger, they're, still looking forward to, retirement in 8, 10 years down the road. It could continue to make sense to have a bigger portion of their money into the stock market. And I think even for retirees, it can be a good place to have a portion of your money in the market. It does show that time and time and time again, the stock market offers one of the greatest growth potentials for long-term investors. The problem is if you look at it when you transition into retirement time, the retiree who went and moved into retirement in 2007 and having all of their money in the stock market, when 2008 happened, and they moved into retirement time, meaning they're no longer putting money into their tax-deferred 401k or retirement account. They're pulling money out, and then all of a sudden the market goes down 30, 40, 50%, and then that investor is also taking a withdrawal from the account. It doesn't take long before they're really upside down pretty fast. When we look at risk for retirees, this one in particular is called the sequence of return risk. The sequence of return risk talks about how the negative impact of losses in the early years of retirement can be a disaster for a retiree. If you take two savers that are growing money and they experience similar rates of return over a period of time, whether the losses happen early or later, at the end of the day, doesn't really impact a saver as much. Another great example of that is my oldest son, Andrew, who works here, is in the company 401k. And a couple of years ago, when we had a downturn in the market, he talked a little bit about his negative emotional experience of looking at a statement and seeing his values go down. And when I explained to him, I said, well, at this point, you're just saving and accumulating. You're buying more shares. So don't worry about it. If anything, increase your contributions because you can accumulate more dollars. And then down the road, when you're at retirement time, that'll be substantially much more in the long run is what the goal there is versus, again, that person that just moved into retirement time. So, what are you going to do about it? And how do you figure this out? If you're the type of investor and you're wondering, with the recent volatility that we saw so far here in August with the stock market, and you're saying, before things really get bad, there's a sense of urgency. There's a sense of moment of time that if you feel like you have too much equities in your portfolio, one of the recommendations that we would do is get your retirement team action plan. And when we go through retirement team action plan, we're going to look at taxes, estate planning, asset protection, and money management. And when we're looking at the money management section of the plan for you, one of the things that we're going to do is we're going to do an independent portfolio analysis. So within that independent portfolio analysis, we can take how your investments holdings are today. And the first thing that we can do is we can give you what the range of returns will be roughly 95% of the time in normal market conditions. And or then we can stress test the portfolio and say, what could be the maximum level of risk if the market experienced like another 2008 or we had a sustained downturn in a portfolio. And before something dramatic and bad happens, it allows you to take an opportunity to look at, Is the portfolio set up to achieve the outcomes that you want? I remember last week we had met with a recent lady that was getting ready to retire, and she had all of her money in a target date fund. And so a target date fund looks generally at the date of when you expect to start to retire and need the money. And what it'll do is it'll move money from equities to fixed income, aka bonds. It's been becoming a very popular topic for the last, 10 or 15 years. And, there's probably 200 different companies to pick from that offer those target date type funds that are out there. The challenge is, though, is if both the stock and bond market have a big sell-off, like what we experienced here recently when the interest rates went up and the market went down, that can really have a negative result on, again, her success as she moves into retirement time. Instead, taking a look at kind of rebuilding out that portfolio, and the way that we recommend building out that portfolio is what we call the independent income system. The independent income system is our belief and methodology on how you should position and put together your portfolios to address the issues of things like reliable income, where you should get a pay raise, where you should put stocks in the portfolio, how you should have emergency and backup plan, how to put a shield over top of your assets to protect them from long-term care, and then what steps you should take to efficiently plan your estate. So if you Google the independent income system, you can get that information. But more importantly than that, there's a sense of urgency. Look at the market, what's happening right now. Now, more than ever, I would encourage you to make sure that you get that independent portfolio analysis. If you have more than $250,000, this could be crucial to the success of your retirement plan and knowing what things look like and knowing how to optimize that overall portfolio. All you got to do is give the office a call, ask for that independent portfolio analysis. We'll put that together as far as part of our retirement team action plan. And get you prepared to, face the upcoming elections and move more confidently as you get closer to or in retirement time.
Multiple things can be true at once. No one out there really wants to kill the goose that's laying the golden egg that has been this really robust market as of the past couple of years. At the same time, they don't want to lose it all in a market downturn, and with volatility being in the picture as of late, that seems more prevalent. You can have the right blend there, not saying all one way or the other, but it really depends on your ultimate, your personal risk tolerance. And that is where that retirement team action plan comes into play. So if you want to take advantage of this offer, the 50, 75 plus years of experience that America's Retirement Headquarters has, let them put that to work for you. Just give a call right now, 419-794-3030 for your retirement team action plan, 419-794-3030, or go to arhq.com.